So in this video, we're going to take a look at the Boston HMDA dataset. That's a historic dataset that we attribute to Munnell, Tootell, Browne, McEneaney 1996. The key focus of their paper, which was published subsequently in the American Economic Review, that race played a significant role in mortgage decision-making, whether an applicant was successful in receiving approval for their mortgage application or were denied. From data that was collected previously in 1990, there was fairly clear-cut evidence that minorities were more than twice as likely to be denied a mortgage compared to whites. And in this data also we will observe that particular trend. The question then that arose, and this is something that we'll try to answer here in our exploratory data analysis, using pivot tables, using summaries, using descriptive statistics, using some basic graphs. Can we say that perhaps the decisions relating to mortgage approval were also somehow linked to the creditworthiness of the individual, and when you included those in the analysis, that then race was less prominent, and that we can account for the divergence in mortgage origination, mortgage approval to the different racial groups. We can account for this by looking at the creditworthiness of individuals. So, okay, so we need to load in some data. We have a pristine data set that's coming in, or almost pristine data set that's coming in from Munnell, Tootell, Browne, McEneaney 1996. And we're going to load it in here to the Google Colab, set up some basic analysis and see if we can answer in a kind of preliminary way, can we form some kind of perspectives on how significant race is in determining the outcome of lending decisions. Now, to do that, typically, there's a couple of ways we could load in the data. We could, there's some links here also, perhaps, that I should advise people maybe to take a look at. There's a paper here from Halvarian, and I used some of his analysis later on for machine learning. So this is a really good paper. It's a revisiting of the 1996 paper by the 4 authors here, and some machine learning code is provided in R. So take a look there. The original papers, going back to the Boston Fed, are available using these hyperlinks, and then the AER, the American Economic Review, the paper, that paper is available in PDF form at this hyperlink here. If we want to run R, and that's going to be mostly what we'll rely on here, also we'll use some Python script, but if we wanted to run R in Google Colab, we must execute this line of code here, and then to install the tidyverse package and then load in, make it available in this environment, we use these 2 commands. To get the data is not a major problem. We could go directly to install packages ECDAT. This is where a number of really nice data sets are available, and then we could look for the HMDA dataset. But that tends to take a long time, and I found there's a lot of latency, about 2 minutes waiting for that to load up. But you could load in our data in this particular format. Just it takes a little bit of time. The issue also is that we should mention here is that HDMA is a kind of misnomer. That's how the HMDA data appeared in the ECDAT package. And so I continue to use this, and this is what I observed also in the Varian paper. So I've left that HDMA as the name of the dataset, even though it probably should be written more correctly as HMDA. Okay, if you need to get To download the data directly, I've left a hyperlink here to a Google Drive. If you just download that, then that CSV file, it'll be available, and it's a CSV file. And then to read in our paper, right, we typically, this is not open, so what you must do is come over here to Files. Might take a second for these to appear. Sometimes you won't see them directly, so you might have to toggle through, but what you're looking for is content. And then so you may have to play around a little bit, but you must find that folder and then come here and then use upload. And then you go into our downloads. Now, what I've downloaded is now being called HDMA4. And it's a CSV file. Because I've downloaded this file a few times, I've got to go back to the actual file called HDMA, and we'll just open up that. So that's make sure also it has that file extension CSV. Okay, so we're good to go. That should load in, and we should note that this is only available while we're running the project. Right, so when we close down the project, go away, come back, we have to go back through this process again. So that's a consideration. Okay, so we want to load in our data, and we want to have a look at this data. We use the glimpse verb here, which is part of the tidyverse suite, and the tidyverse suite is quite a nice one because it has the ggplots, ggplot2, and it has the plier, which is useful for data manipulation. We run that, and then we can take a glimpse at what's contained in the data set. So there's some interesting columns here. We have 2,381 rows, so it's organized as a transpose. And so the rows, if you like, are each of these. So for each individual, either they were denied mortgage, no, that means they were approved. So no means to deny is like a double negative, so you were approved your mortgage. But here, yes, somebody was denied, that means you weren't approved your mortgage, you were denied. And likewise here, the term that's being used here is black. It denotes both Hispanic and African Americans. And for the most part here, it was no in those first few observations. The condominium is a bit of a misspelling, but just denotes for European viewers apartment, right? So instead of standalone house, are you buying an apartment, right? Probably multifamily. Then unemployment rate in the applicant's profession, and some professions have a higher levels of unemployment. Was the individual single? And you can see these are recognized as factors. That mightn't be the case in every data set that you get, but correctly R has introduced the data in, and it's read it correctly. Black is not an integer, it's not a string, it's a factor, right? So you're either one or the other. Deny, it's either you get the mortgage or not. Likewise for single, you're either married or you're not. You're self-employed or you're not. And then DMI, also a factor. It relates to denied mortgage insurance. So for many types of mortgages, you must have insurance. And also for mortgages, that's to protect the lenders. And also, if you wanted to securitize the mortgage, there may be provisions or covenants that demand that the mortgage has insurance. The PBCR is the public bad credit record, and that would be relating to were you owing money to banks and didn't pay? Is there a lien against you for taxes and so on? And then we have mortgage, again, it's a factor, it's either or. And then we have credit scores, consumer credit scores, and then mortgage credit scores. and they range from 1 to 6, 1 to 5, and then 1 to 4. We'll have a look at those later. Loan to value ratios important in determining credit worthiness. Also, and the higher your loan to value, the more risk you pose to the bank, and the more they stand to lose in the event of having to do a fire sale on the property if the individual can't meet their mortgage repayments. And then the household expenses to income ratio, and then the debt to income ratio are also measures of credit worthiness. Here we have more description in terms of the definitions of each of the variables, and we can also run some Python code here. So we load in, we'll do some basic analysis. We can load in the data, or load in the relevant libraries, should I say, load in the data. So we're reading again from here, and that data comes in. And then to describe the data again is to provide descriptive statistics. So we, in each instance, we're counting the number of observations, 2,381. And we have the mean of DIR, the mean of HIR, LVR, CSS, the standard deviation, the minimum, the maximum. And it's interesting, we can see LVR, the maximum is close to 2. The credit, consumer credit, the maximum is 6. So I said 1 to 6. For the mortgage credit score, it's 1 to 4. 1 being the best, 4 being the worst, 1 being the best for credit scores, 6 being the worst. Unemployment rate in the individual's profession, and then is it what proportion, about quarter of loan applications were for condominiums, right, apartments. We can have a look at the head. Again, this is Python code, and this is just something similar to what we have here, I suppose, just for the top 5 rows. But in this case, we can see column, the way the columns are organized, and here the rows. And up here in the glimpse, we're getting a transpose of that. It may be slightly more elegant in some ways, but at least this might be more intuitive, should I say. This one here, more intuitive in terms of our conventional understanding of columns and rows 1, 2, 3, 4. Okay, so is there any columns that are missing some data? For self-employed, I think there's one. We might take a look at the data. If we double click, we can take a quick look at the data. Now it's there's too many observations, but I think going towards the end, then we may be able to see, I think it's the last one where there's issues. And for the last applicant in the data set, there are some funny numbers here. For instance, the credit score doesn't look right. It should be 1, 2, 3, 4, 5, 6. Then the mortgage credit score, also this is not a whole number. It looks funny. This is not available. The public bad credit record, and self-employed or not self-employed. So it looks like it could be a sort of made up, corrupted observation, and we probably need to get rid of that observation out of the full data set. So it's close to being a pristine data set, but that seems to be the last observation, seems to be a funny one. Again, using Python code, we can read in this command, and we can see that for deny 2096 were approved. That means no to deny, they were approved, and 285 were denied, right? And then if we count the numbers in terms of denied mortgage insurance, the bulk of people were receiving mortgage insurance, but 48 were denied, okay? And then we look at the minority compared to others. There was 339 applicants from minorities to 2,042 who were white. And if we did a correlation matrix here, it won't run correlation matrix for the factors, right? But it does it for the doubles, right? And so we get a limited correlation matrix here, and we can look at some patterns in the data here. There's a positive, there's a positive relationship between HIR and DIR. You would expect that, and that's probably grounded in, hardwired in. Also LVR, if the LVR is slightly higher, that DIR is higher. There's a positive correlation between DIR and the credit scores, mortgage credit scores, but also close to zero, probably close to zero, and also close to zero. So that there isn't really strong relationships on these last four ones. Possibly a strong relationship between this and DIR, but it's an incomplete correlation matrix. Okay, so I'm going to finish this video clip. That was just the basic introduction. How do you load in data into the Boston HMDA dataset? How do we load it in? If we use packages, it can be a bit slow. So you can download through the hyperlink. Once it goes into your download folder, then you can read in using the R command. You remember you have to load into your upload into your content folder to make it available, and then you read that file that's available here in the content folder into your R project. And then if you have tidyverse installed, you can use the glimpse verb. That will allow you to showcase your data set a bit and determine what type of data you have. And then I use the Python then to do some other basic descriptive statistics. And okay, so that's that first video. We'll stop here. And in the second video, I'll continue on using some base R and some further analysis.